Before I get started, I wanted to make sure everyone knows that my colleague Matt Barber is here with me in the middle table. Raise your hand, please, Matt. So Matt's our analyst, been with us for a long time. He helps us incredibly much, and so if you ever want to talk to someone at Idea Fund Partners and you can't get a hold of me or you can't get a hold of Lister, certainly get a hold of Matt. He's also a great resource. So as Adam said, I'm just going to speak a few minutes. We don't have a ton of slides. I know you all aren't dying for 36 PowerPoints about our perspective on the Triangle investment landscape, or really the Triangle startup ecosystem. And similar to what I have to deal with listening to NPR every day, there's going to be a little bit of pseudo-commercial in here, but not too much. So who is Idea Fund Partners? As Adam mentioned, we are a seed and early stage technology-focused venture firm headquartered right here in downtown Durham. We were founded in 2007, so we've been active for right about 10 years. We like to think of ourselves as patient capital, so we invest very early and we stay with our companies as long as it takes. We typically participate in anywhere from 3 to 4 rounds of financing over the life of a company, so it's not one and done. Like maybe some typical angel investors. We're a pretty experienced team. Myself and Lister have been investing together since 2003. We've been doing it as Idea Fund Partners since 2007. And since neither of us were ever technology entrepreneurs ourselves in the purest sense, we have made a point of surrounding ourselves with investors and advisors who have a lot of technology and startup experience. One example I like to give is operating partner in Charlotte named Chris Halligan. Chris was the VP of Inside Sales at Dell Computer in the 90s, so he helped grow him from 100 million to 10 billion. And he's done 3 startups since then. I'm happy to say we just invested in his most recent startup in our first Charlotte company. So our mission in life is to be the go-to investor in the Southeast for technology startups. So as Adam said, we are the most active tech VC in the Southeast. It's not our data. That's actually PitchBook data says we're the most active in the Southeast. This is actually CB Insights data, and certainly it looks like we're the most active in North Carolina. So why invest in the Southeast? You know, when we go out to raise capital, which we have to do, by the way, every 3 to 4 years, and it's just as much fun for us as it is for you. We focus on the Southeast and Mid-Atlantic, so we define that as Baltimore down to Miami. And we get the question a lot of times from institutional investors, why the Southeast? And for us, the reason why the Southeast has a 2-part answer. The easy part is because that's where we live. And we like to be close to the investments we make. But frankly, the more important part of the answer is the Southeast is an underserved market. And when we use the term underserved, it's got a specific definition. And that means that the amount of early stage capital is not matched well with the amount of innovation and managerial capital in a given area. So if we went to Kernersville, North Carolina, that's not necessarily an underserved area. Not a lot of resident capital, probably not a lot of investable opportunities. If you look at the Triangle or Atlanta, Greenville, South Carolina, certainly parts of Florida and DC, there's a lot of capital. There's a lot of capital to work with in the sense of human capability, in both innovation and, again, managerial capacity. And those are the 2 things we're looking for. So this, again, actually is not our data. It maps well against data that we put together about 4 years ago when we were getting ready to raise money and knew we would be getting this question from investors, why the Southeast? Matt and a couple interns actually spent a long time assembling all of the data available for investments made across the country in early stage between 2000 and 2005, and then all the exits between 2006 and 2010. And when we ran the numbers, we came up with very similar results, though our numbers were actually smaller from an absolute multiple standpoint, that the Southeast came out ahead of Northern California in terms of dollar-on-dollar return for invested capital. That's pretty cool, because at the end of the day, that's what our investors care about. And this is more recent data from PitchBook, and it's probably a little bit surprising. Washington, D.C. is on top, the Triangle is third, Atlanta is fifth. And the moral of the story is, as an investor, you can make really good money investing in startups in the Southeast. And again, part of that, we think, which is good for us, not so good for you, but we'll talk a little bit more about that, is because there's still a little bit of a mismatch between how much investable opportunity there is and how much resident capital there is to chase it. So how does the triangle itself compare? So this chart on the right is Idea Fund Partners deal flow, so that's just our fund. And this isn't our entire deal flow. We see about 800 deals a year, so this is just our triangle portion of our deal flow. And you'll see that it's been growing each of the last 4 years, and that's the trend that you want to see. And that means there's more startups being created. You know, as Adam mentioned, we were one of the initial tenants of the underground that's actually underground on American Tobacco. And it's amazing how over the last 6 years, this community alone has grown. I was just in Greensboro earlier this morning for a meeting at HQ Greensboro. They have 160 companies that participate in HQ Greensboro. And it's Greensboro. It's not Durham, it's Greensboro. So a lot of activity going on. You'll see all these logos down here on the right. These are all funds or firms, all but one are from outside of North Carolina that have invested in Triangle companies in just the last 3 years. Is that right, Matt? So that's just the last, there's a number on here that had invested, if you go even 1 year further, several of them in companies of ours. And we didn't count, for instance, one of the companies in our portfolio called Distill Networks, which was started by 4 NC State guys in the Triangle. They've been out in San Francisco for a few years, but they're invested in by Foundry and Bessemer and Silicon Valley Bank's venture funds. So you certainly can do it. But getting back to the resident capital question, one of the things that has continued to be a positive development in the Triangle from our perspective is the true early stage capital. So these are mostly individuals, some angel groups, and then some smaller funds like ours. So these are folks like David Gardner at Co-Founders Capital, the Bootstrap Advisor guys. Now there's Full Tilt. I'll put the Bull City guys on there because I'm nice, even though they're really a tiny private equity fund. RT Capital, TAP, NextGen, and now we've got the Duke Angel Network, and soon to be the UNC and NC State Angel Networks. If you're looking to raise $250,000 to $750,000 and it's kind of your first slug of money, you should be able to find it in the local ecosystem. It's always hard to raise money, so I'm not saying it's not, but you've got more than a couple shots on goal, and that's great, because what that means is, and what our model is, we realize because the Series A investors, like the ones in the corner, have to get on a plane and fly down here, the bar is a little higher. They want you to be a little further along before they're willing to spend time and make an investment, right? And if you're a software company, the bar you probably hear a lot is $1 million in ARR, or $1 million in ARR. So a lot of what we look for and try to do is, can we put together an investment syndicate that collectively can get a company to $1 million plus in ARR, at which point we're pretty confident we can help them bring investors in from outside the area. So Idea Fund Partners has invested with over 50 other venture funds from outside of the state in the last 10 years. And we know that when you get a company to a certain point, they're more than happy to come down and invest. So why do people like to invest in the Triangle, and why is it a great place to start a company? And I'm preaching to the choir here, you all can correct me. But, it's the same thing you read on the magazine covers and in the surveys and the Chamber of Commerce likes to promote. And it's the old, it's a great place to live. When I moved down here in 1993, it's a great place to raise a family, which when you're 23 years old, you're like, I don't really care that it's a great place to raise a family. I like that I can bike all year round, but that is an attractive thing. And the cost of living and the lifestyle makes for a great environment. How many of you have lived and or worked in Silicon Valley or Manhattan? How does this compare as far as quality of life? It's different, right? But I think most people I talk to find, especially the ones who have a family, find it's better. And that's a powerful thing, because as you all try and build your companies, I'm very confident you can recruit people from outside the Triangle to join your team and help build your company here. And that's what we need to continue to see. It's great that we've got 150, three-person startups. But what we want to see more of are the Red Hats and the Brontos and the Max Points and the Channel Advisors and the companies that grow and ideally they IPO or go public, and maybe they get acquired. But in the case of Bronto, which is key, when Bronto and Automated Insights, both of those companies, when they got acquired, you'll notice they didn't downsize. They didn't move the headquarters of that business unit. In both cases, they were left as mostly standalone entities that the parent wanted to grow in the Triangle, because they know the Triangle is a place where they can attract both development talent and business talent. So those companies have both been expanding here in Durham since the acquisitions happened, and that's very important. So, as I mentioned, we think the keys to both expediting or speeding up and expanding the growth in the Triangle ecosystem is we can still use more talent, or I should say more experience, of people who have already made that journey once of going from 0 to 5 million or 5 to 50 million. We've got more of the 0 to 5 than the 5 to 50, or even the 50 to 500. And so those are the type of people that we need to continue to attract to the ecosystem, so that as you all get your companies off the ground and on those growth trajectories, we can help maintain those growth trajectories because you've got access to human capital that can do it. And quite frankly, the other thing is success begets success. It's a lot easier both to get people to start up companies and to get other people to join startup companies if it's easy for you to see an example every day that's close by and attainable. If you don't have to look far, or you don't have to think too hard to say, gosh, do I even know someone who's had a successful exit in the last 1 or 2 or 3 years? Or, do I know someone who's made a bunch of money, or someone whose product now is available across the world and it's really widely distributed? Our venture partner that I mentioned, Chris Halligan, who's from Dell and was there in the 90s, Dell basically made Austin what it is. And Dell made Austin what it is because it's estimated that during the 90s, when Dell was the #1 performing public stock for that 10-year period, Dell created 1,000 millionaires. 1,000 millionaires. And at that time, I think Austin was about the size of Durham. So think about the impact that type of wealth has on a community. Chris decided to move out of Austin when they were flying with their kids to spring break one year, and they're like, how come we're not going private? So they thought that was probably a good time to leave Austin. But it's true. Success begets success. If you see companies that are growing and scaling, raising large rounds, and ultimately getting to successful exits, and entrepreneurs that are hopefully recycling both their money and their experience, that's just going to put fuel back on the fire for the Triangle ecosystem. But certainly, you don't have to look far to see all the activity, which is meaningful, both here in Durham, and you're at the epicenter of it right now, but also over in Raleigh, and the things they have going on there, and even in Cary and Chapel Hill. So we think it's a great time and only getting better from the Triangle perspective. I'm going to end my lecture now, and hopefully there will be some questions. Bueller? No one's old enough to know that probably. Wow, that good, huh?
What questions you have?
I answered all of them. There will be a quiz for more tickets.
So, as more of an institutional investor, where do you see the role in the investment ecosystem in the southeast of the new crowdfunding rules and regulations that have come out recently?
Yeah, sorry, so let me put on my last, I forgot I had one more slide. So, where do we fit in? Just so you know, so we have deployed 70% of our capital in the Triangle since 2007. So of the investments we've made, 20 of those are in Triangle companies. And what was surprising to me is that ratio has actually increased. I thought we would do more investments outside of North Carolina in the Triangle as time went on, but the deal flow there are so many quality companies here in the Triangle, the percentage of our investments have been in the Triangle. So what do I think the crowdfunding things are going to do? Well, so I'm biased, right? So you're basically actually asking a mutual fund manager whether I think people should do their own stock picking, right? So with that out on the table, I don't think people should do their own stock picking, generally speaking. I don't think the average retail investor, investing in startups is really hard to do, even if you do it professionally. I can tell you that because I try to do it. And the earlier you invest, the less information there is to base your decision on. So if you think of yourself sitting at home in your living room and going on the Malartu website and looking through the materials of some company they have there, you can make an assessment perhaps of what they're trying to do or what they're doing. But unless you have the time and you have the ability, well, I should say the time and the access, so you have to be able to get to them, and then the ability to know what questions to ask and what things to look for. I think that true far side use case of crowdfunding is going to be tough. I do think things like AngelList and some of the things we're doing to try and make early stage investing available to, in our case, accredited investors, as with AngelList, I do think those are good and helpful. I don't know how far it's going to go. I think there will be a place for it, but I think it'll be interesting to see how well it works economically. In the red shirt.
Yeah, so because it seems like there's less investors in the Southeast, which kind of creates a supply and demand problem sometimes, not access to capital, just the amount.
Right.
What's your opinion on the idea or the notion that entrepreneurs don't get as good at terms being in the Southeast as you put out in Silicon Valley because there's just fewer offers. It's harder to get multiple term sheets. It's harder to kind of go that way. Do you think that's actually happening? Do you think that's a true opinion, or what do you think about that?
I will answer it a little bit differently than you asked it and say that valuations are generally lower outside of Silicon Valley. Yes, for the reasons that you mentioned. And that's why we like to invest in the Southeast, right? So, but there's another reason for it, and this is, I think it's a reality, but it's a knock again that we hear when we talk to the same investors who invest in Silicon Valley venture funds and other things, and that is, you don't think big enough, and you don't have big enough exits, right? So just as your experience is formed by what you do every day and where you live, so is mine. And the fact is, I live and invest in the Southeast. Who can name a $1 billion tech exit in the Southeast in the last, I'll give you 10 years? No. No. Go look them up. Blackbot never got to $1 billion. No. 800 million at its peak. But when it IPO'd, it was about a third of that. Red Hat was, but it was more than 10 years ago. And there have been a couple in Florida. But my point is, well, I guess Magic Leap, if you believe what it's worth on paper. But my point is, and I don't want this to become a downer conversation, is, you know, it's hard to project that type of outcome when, and that's the point I was making on the previous slide, when you don't see it every day. And so we try and invest with a mind towards what is a probable, though even that's a bad word to use when investing really early, what's a probable outcome? And certainly we hope that we're investing in companies that have the potential to get there. But and the last thing I'll say on that is, if you're out in Silicon Valley, there's a lot more investors. There's also a lot more startups who are chasing those investors. So I would say the early money is easy. It's still hard to get that next stage of money, which is why, you know, you've read as much as 2 years ago about the, you know, the Series A crush and all that stuff. Do you still have a question?
Yeah, I had a question. Just curious, I read that you guys will invest in device companies, but no biotech like pharma type of. So why are you not doing? Is it just the cost of capital for pharma?
3 reasons, and this is one area where at least we've been consistent since 2003. So it's too much time, it's too much money. None of us come from that space. So not only do we not know the science, and that's one area where you better know the science. So we not only don't know, but we don't even know the people who know the science. Medical devices is enough removed, and I have a lot of scar tissue even to show for my medical device investing, but it's enough removed in most cases that it's not really technical risk you're taking on. It's development risk, it's regulatory risk, and quite frankly, the greatest one is financing risk. So we can get comfortable with those on the medical device side. But if you're, you know, if you're the guys at Hatteras and you're investing in true early stage therapeutics, you gotta feel good about the science. And as much as I hate to admit I don't know something. Yes, sir.
Is there a type of company that you think that the Triangle is better equipped to help grow than compared to other places throughout the country, like because of organizations?
B2B software. B2B software. Yeah. How many of you are software company people? How many of you are actual developers? Keep your hands up. How many of you consider yourself a front-end person? And how many of you back-end people? Nowhere. That's why, right? And that's maybe, and I think that's one area where the triangle can even get stronger and get deeper, is if you're trying to build big, hairy, enterprise scale systems, we're awash with those type of people, not just in the startup ecosystem, but at UBS and the Park and Fidelity and now MetLife and all sorts of other, and Cisco's got gobs of engineers. Those Cisco people probably couldn't name 2 of the companies in this room, most of them. It's like an alternate universe. But we've got good front-end people. We can always use more good front-end people, more good UI people. I would say we don't have a ton of depth in consumer products yet, and that's something that Adam and his team are actually, as you've probably heard about, putting a program together. The next Startup Stampede is actually going to be focused on consumer products, so they're doing a really good job of pulling mentors together who do understand that space. But that's my biased opinion. Yes, sir.
What do you look for in terms of traction for idea stage companies?
That is a great question, because traction is a word you hear a lot, and it's a word we use a lot, traction, momentum. I like to use momentum because, we've learned momentum is really important, and it's really hard with the earlier you are, right? The obvious one is revenue is the best indicator, but if you're idea stage, what do you look for? So I think there's a couple things you can look for. One of which is, who are the people that are willing to associate themselves with the problem you're trying to, or the thing you're building, the problem you're solving. You are in part judged by the company you keep. So for instance, if you can attract just crackerjack developers to work on this with you, that tells me there's probably something that's pretty hard or pretty cool about what you're doing, because I've been around developers long enough to know that the really good ones, the thing they care about the most is what I'm working on really hard and or really cool. And then the other thing is, just from you don't necessarily need to have revenue, but you might have users, right? You might have, if you're a B2B company, you might at least have alpha or beta users that aren't paying you yet. Or if we're a consumer-focused app, we're certainly, I'll tell you, with consumer-focused apps, we aren't going to invest in you prior to showing some traction, because we haven't been able to figure out what that algorithm looks like ahead of time. But if you have traction, then we can evaluate that. So that's the best I have to give you.
Any other questions?
Yeah, we're here. In terms of momentum and revenue, right? What's the scale at which your ears perk up? You're like, oh, okay, like 100,000 in revenue, 200 in revenue. It doesn't matter if it was over a year versus 6 months. Like what are the things where if just like in an elevator, right? You hear these 3 things and you're instantly like, we need to talk. What's that look like?
It looks like, let's see, today is October 19th. It's like, yeah, we just released our product and started selling in July, and we're already at 100,000 in revenue. So it very much is linked. So, if that one axis is time and the other axis is revenue, we definitely want to see the relationship so that it's a strong slope of the curve. Right, if you're at 200,000 in revenue, but it's taking you 2 years to get there, we're probably going to be like, okay, maybe you have something. But speaking for Idea Fund partners, we have a strong sales culture bias when it comes to our companies. And that is because over the years, we've met a lot more good product people than we have good go-to-market people. And we know that good product can languish in the corner in the absence of good go-to-market people, and quite frankly, mediocre product can sell like hotcakes if you've got really good go-to-market people. So we are we are biased towards, again, that culture. And so there definitely is a relationship between revenue and how long it's taking you to get there. There's no magic number for us. You know, and part of it depends on the price point. If you're selling a $99 per seat per month thing, and you've been able to go from $0 to $100,000, you know, in 6 months, or I don't know, maybe even 12, that might be interesting, more interesting than someone who's selling, you know, a $70,000 a year enterprise license and they've sold one who's renewed. So, just some examples.
Is there,
Yes, sir.
in the window where you invest on the revenue side, is there a top, if we're not talking about follow-on investment in a company where you say, no, now we defer to something for other funds?
Probably. But I think that partially depends on the price. If we can get in a more mature company that we think has a lot of room to grow ahead of it at the right price, then, I mean, clearly if they're doing, I would say at the absolute edge, probably around $5 million a year, and that's the edge case. But we just did a couple that were around, one that was around $2.5 million run rate. But we knew one of the key members of the team for a long time, and we had co-invested with their lead investor, so it was kind of a different, we had been watching them, so it was a little bit different. And then the other one was at about $1.5 million revenue run rate, but they hadn't raised any money before it. They had bootstrapped to that point, so we were still the first money in. So I don't have a bias against more revenue.
All right.
Thank you, Matt.